In this video, I want to go over 10 money habits that keep so many people broke. Now, I'm not talking about the plain old obvious bad money habits like not waiting for your paycheck and then going to a payday loan person who's going to take a big chunk of your paycheck to give you your money a few days early, and then you take whatever's left of your paycheck and then you go over to the Gucci store or you go over to the Louis Vuitton store and then you finance an ugly $600 handbag that you can't afford. I'm talking about the habits that aren't so obvious. For example, number one is taking money advice from broke people. I invest in real estate. I invest in single family homes and apartment complexes and mixed use buildings. And when I first started, I started off by investing in single family homes, which I would rent out. And a few people that I knew that were close to me started learning that I invested in real estate. Well, after I had a few single family homes under my belt, I went out and I was going to buy my first apartment complex. It was a small little complex. It was on sale for $260,000. And the reason why it was so cheap was because this complex was completely run down. It needed a ton of work. Nobody was paying rent there. It was essentially being used as a place where people would sell drugs. And so when some people who knew me found out that I was going to buy this complex, they had very negative opinions. You're going to lose money. It's too big of a deal. You're overpaying. The market's not good, because this was still at the bottom of the 2008 crash. This was after that whole real estate meltdown. So there was a whole bunch of negativity towards this deal about how it's not going to work because of the type of building that it is and where it's located. Even though it was in a very good area, this wasn't in a bad city. It was in a great city. It was just a very rundown building that was being used for a lot of bad things. Well, I bought the property. It took me a little while to get it fixed up and renovated, but about 18 months after I bought the property, I had it fully leased out. Now I had tenants that were paying me rent every single month, and then a few years later, I sold the property for about $650,000. So yeah, it wasn't a bad deal, but if I had listened to all the broke people around me that had all the negativity towards the deal that I was doing, I wouldn't have made any money and I wouldn't have gone through with the deal. Here's the thing that you have to understand about listening to other people's advice. Sometimes people will give you good advice. Sometimes people will give you bad advice. Now, the reason why people will give you bad advice might be because they've never done this thing before, so they can't give you good advice. And the other reason why some people might give you bad advice is because, well, they don't want to see you succeed. Actually, let me rephrase that. Most people want to see you succeed. They just don't want you to be more successful than them. Everybody in the world has an opinion, and everybody is going to give you their opinion. It is your duty not to just blindly follow everybody's opinions, but listen to them, learn from them, and then apply what's best for you. Because the reality is, if you just blindly start listening to people who have never done what you want to do, chances are they don't know what it's going to take for you to get to where you want to be. Like, if you want to be a real estate investor, you should listen to people who have been or are real estate investors. If you want to be a millionaire, you should listen to people who are millionaires. If you want to build a business, you should listen to people who have been entrepreneurs, but not just entrepreneurs, but successful entrepreneurs. It pays to listen to people who have actually done something, because they're going to give you more brutal and honest advice versus people who are broke, who have never done anything, might just say something to make you feel good, or they're going to make you not do anything because they don't want to see you succeed or because they don't understand the concept of risk. Second is RSD. Restaurants, drinking, and smoking. The University of Chicago published a study covering the real costs of smoking. And what they say is that over the lifetime of a smoker, the costs that you have to pay are not just the cost for cigarettes, but you also have an additional cost for the additional health costs that you incur because you smoke. And then you have the financial lost opportunity costs because you spent so much money on cigarettes. You spent so much additional money on healthcare costs and services that now all this money that you spent could have been invested to make you wealthy. And the study shows you that over the lifetime of somebody smoking, many times the cost of smoking isn't just $100,000, but many times it's $700,000, $800,000, $900,000, or even over $1 million, depending on what state that you live in. All in all, the research shows that smoking will cost you $1.4 million over your lifetime. That's an expensive smoke. When it comes to drinking, I don't drink. But if you really want to drink, that's fine. But this is where you can be a little bit smarter with your drinking habits. Because I used to be in the event planning business. Meaning, I used to host parties, concerts, and shows back when I was in college and a little bit after college. And there's a lot of money that can be made by selling alcohol at clubs, at restaurants, and at bars. And the people that pay the money are the people that are drinking. Now, if you are struggling financially, you don't want to be spending your money on alcohol when you don't need to. Like if you really want to drink. Now, I don't condone drinking, but if you really want to drink, don't drink at the restaurant or the bar. Drink before you leave and have somebody drive you. Even if you pay for an Uber, it's going to be cheaper for you to drink at home than drinking at the restaurant and drinking at the bar. So if you drink at home and get an Uber, not only is it going to save you money, but now you don't got to worry about driving. And a hack that I used to use when I started eating at restaurants, because for a long time I used to go to restaurants with my friends, but I never ate there as a way for me to save money, because I would eat at home because I knew it would be cheaper, and then I would just drink water at the restaurant. But when I finally started eating at restaurants, the hack that I would do was I would eat before I'd go to the restaurant. That way I didn't have to order an appetizer and I could just order my meal as a way for me to save money. So if you wanted to implement something like that, you could eat before you go, you could drink before you go, if you want to drink at all, but then you can go to the restaurant and just order some food. That way you don't have to pay for drinks, and that way you don't have to pay for an app. As a way for you to save money, but you still get the restaurant experience. The third habit that keeps so many people poor is that you have a small, limited mindset. If you make $50,000 a year, and let's say this pie represents your $50,000 a year income, well, you might want to put some money aside for your savings and your investments. And let's assume that you're putting aside $10,000 a year for your savings and your investments. So you're putting aside 20% of your income for your future wealth. Now, you might start liking this investment thing, and you like this idea of building wealth, and you're gonna say, oh man, I want to put more money aside to buy more assets, to invest more money, to become more wealthy. And so what do? Well, you start squeezing more money out of the pie. Maybe you go to 15,000, maybe 20,000. And now what you're doing is you're trying to squeeze pennies out of your limited pie. And this is good in the short term, but it's not scalable in the long term. Because if you really want to become wealthy, what you can also do is, instead of just trying to squeeze more pennies out of the pie, is you can work to make the pie bigger. Because now if you go from $50,000 a year to $500,000 a year and you live off of the same ratio, well, now you can put aside $100,000 a year, which is the same 20% of your income, but now you have way more dollars being put aside towards your investments and way more dollars putting aside towards your savings to make you wealthy and to protect you against a financial emergency, but you also have so much money to live way bigger. So it's a way bigger benefit. Now you might be saying, but Jaspreet, how in the world am I going to go from 50 to 500? Well, this is where now you got to start thinking a little bit different. Because if you don't think or believe that you can go from $50,000 to $500,000, I can guarantee you're not going to take any steps to go from $50,000 to $500,000. But this is where now, if you believe that you can do this, if you want to do this, then you're going to start learning about how to do that. You'll start reading books about how to increase your income. You'll start watching videos on how to increase your income. Maybe you'll take a class on how to start a side business. Maybe you'll actually start investing into your own side business idea, your own side hustle idea, your own business idea. That way now you can start creating more income. Or maybe you'll start working as a salesperson. That way you can start adding some more commission to your life in addition to your job. There are so many ways to increase your income. It is going to cause more work. It is going to take more time. It's going to take more effort, but it is possible, because if your goal is to become financially wealthy, well, then you're going to have to start building this abundance mindset, because so many people get caught up on the idea of just squeezing pennies when in reality, a penny saved is just a penny. I'd rather you focus on the dollars, if not the tens of thousands, if not the hundreds of thousands of dollars, instead of just focusing on the pennies. Because now you're going to be able to build a lot more success, you'll be able to build a lot more wealth, and you can still enjoy your life as well. Now, if you want to learn more about how to invest your money smartly, and you want to stay up to date on what's happening in the financial markets, well, that's why I created Market Briefs. It is a free newsletter to keep you up to date on what's happening in the financial markets. That way you can be a better investor, because when you invest your money smartly, you can also increase your income. Market Briefs is completely free, and if you're an investor who wants to stay up to date on what's happening in the markets, then you can join Market Briefs by clicking the link down in the description below. Number 4, you're spending money that you don't have to buy things that you can't afford. Now, in the beginning of this video, I gave the example of you going to a payday lender to get some money. That way you can finance a Gucci or a Louis Vuitton purse. Well, that's a little bit obvious, but now through the advent and growth of fintech technologies, you can now buy a whole lot more things that maybe you can't afford, thanks to things like buy now, pay later, or as I like to call it, broke now, broke later. The only people that are making money when you're borrowing money to buy things that don't make you money are the banks and the lenders. And you might be saying, but Jaspreet, the buy now, pay later stuff is free. It doesn't cost me any interest. It's 0% APR. Well, if that was the case, how come these buy now, pay later companies are worth billions and billions of dollars? And how are they making so much money? Well, it's not because they're not making any money, it's because they are making a lot of money. It's just many times hidden for people. The way the process works with anything that's 0% APR is that now you don't have to feel the pain of spending $1,000 today. Instead, what you do is you're just going to pay it off in small little installments of $50 to $75 a month. And now what you do is you just bought yourself a $1,000 sofa and it's only costing you $50 to $75 a month. Well, now that you have this sofa, you're going to need a new TV to go along with it. And if you want a good TV, it's going to cost you $2,000, but you don't got $2,000. You could go out and buy a $150 OK TV, but the $2,000 TV is only going to cost you $125 a month. So what do? Well, if you're like most people, you're going to buy the nice $2,000 TV and only add another $125 a month to your monthly payments. Now, you don't have to feel the pain of spending the $2,000. You don't have to feel the pain of spending the $1,000 on the sofa, but you have all the nice stuff. And when you keep doing this, now you have the ability to go out and buy more things because you never had to actually feel the pain of spending the money. But you're also accumulating all these monthly payments because now you have a whole bunch of stuff that you're going to be working to pay off over the next 12 to 18 months. And what ends up happening to so many people is you start making the payments, but you can't make the payments fast enough because you bought so much stuff. And now if you can't make the payments fast enough, well, now you get slapped with a big fine and you got to pay big penalties and you're going to have to pay a big interest rate, just like financing things off your credit card. So you thought you were getting free money. But the most expensive kind of money is free money, and this is where you want to be paying for things, especially liabilities, in full, not finance them, even if it's 0% APR. That way you never have to worry about the money, you never have to worry about the price later on. Number 5, you are overpaying on your biggest expense, which for many Americans is taxes. You have to pay taxes on everything. You pay taxes when you earn money, you pay taxes when your investments make money, you pay taxes when you sell an investment for a profit, you pay taxes when you buy things, you have to pay taxes on your home, you have to pay taxes on pretty much everything. But this is where you want to make sure you're also not overpaying on your taxes, and the more money you make and the wealthier you are, the more valuable this is going to become. If you are making over $100,000 a year, or if you have a business, you need to have an accountant who's going to help you manage your money and who's going to help you manage your taxes, because I am a licensed attorney and I can tell you that the IRS code is over 2,000 pages long, and it is going to be impossible for you to read the IRS code, understand it, implement it, and get the best tax returns for your money and still be able to operate your business or work your job. And so what you want to do is hire a professional who all they do is understand taxes, because now you're paying them to lower your tax liability. And there are many things that change year over year, where now your accountant's job should be not just to file your taxes, but to find the best deductions for you. That way you can pay less money in taxes legally. I'm telling you this from experience because I have worked with bad accountants and I have worked with good accountants, and good accountants will pay for their expense many times over because they will save you that much money in taxes and some, which is why you need to make sure you have a good accountant on your side. Now, if you're making under $100,000 a year, it might not make sense for you to pay a few $1,000s or more for an accountant or a tax professional. However, you still want to make sure you have some sort of software or something that can help you file your taxes and get all the deductions that you qualify for. There's a ton of softwares on the internet that can help you file your taxes at no cost. So just do your research and find an application that way you're not doing it yourself. Number 6 is you want to get rich fast. Nobody wants to get rich slowly. That's not attractive and that's not interesting. Just like how building a six-pack in 3 years isn't very interesting. People want the six-pack next week. But the reality is, if you buy into the idea that you're going to be able to get rich in 6 months by following a simple 5-step plan, chances are you're going to fall into some type of scam, some type of get-rich-quick scheme that's going to make not you rich, but it's going to make the person selling the get-rich-quick scheme rich. And this is where you got to be able to decipher the difference between actually finding a good investment or a good business opportunity versus just some scam where it's just selling you some hypey product that's not going to do anything. Because the reality is if you want to make a lot of money, it's going to take a lot of work. It's going to take a lot of effort, and it's going to take a lot of time. And if you're not willing to go through that pain, it's going to be very difficult for you to become successful, and you're going to keep buying into this whole dream and hope and desire of trying to get rich, because there's a lot of industries out there that prey on people wanting to get rich quick, that prey on people that want the nice things right now, that prey on people's desires and sell products which are complete crap to get you to pay them money for this thing. And this is where I want you to be a little bit more educated and understand that if it sounds too good to be true, it probably is. And if you just want that money right now, well, then you got to be able to put in the work, because the more effort you put in, the more you learn, the faster that you'll be able to achieve that success. But understanding that if you're not willing to sacrifice that time, you're not willing to sacrifice that effort, well, then you're probably going to buy into something that's a get-rich-quick scheme, and you're going to be the one that loses the money to it. Number 7, you don't understand how our system works. We live in a capitalist system. Now, just that word makes some people very angry, and it makes some people very happy. I really don't care what the emotion is. What I'm trying to get you to understand is this is what the system is. So if you want to become successful in this system, you have to understand the way the system works. And in a capitalist system, you can make money one of two ways. You can make money from your labor, or you can make money from your capital. Your labor is when you go to your job. You work and you get paid. That's how most of us, if not all of us, are taught how to get paid, but very few people understand the second way that you can get paid, which is through your capital. And in a capitalist system, the people that make the most money are people who understand how to make money from their capital. And this is where now understanding how you can invest your money through your capital, because capital means money, that way you can make more money. Because some of the biggest industries, institutions, corporations in the world, how do they make so much money so quickly? Well, what they do is they buy an asset for a lot of money, like $1 billion asset, and then they sell it for a little bit more. If you buy an asset for $1 billion and you sell it for $1.1 billion, you just made $100 million. Now, I get it. You don't got $1 billion. But now you can start scaling this down more and more and more. Because now if you can buy an asset for $1,000 and you can sell it for $1,100, but now you just made 10%, which is the same as here, or $100 through your capital instead of just through your labor. This is where you buy an investment, you hold it, and you sell it for a profit. Now, if you can hold on to your investments for a longer term, you can see bigger returns. And if you can keep investing more and more money, you can also see bigger and more returns, because now you're constantly working to buy more equities, to buy more assets with your capital. And this is where you got to understand that the real wealth in this country is not built through working a job. When you work a job, you get paid, you get this cash, but now you want to convert this cash, this capital that you have, into an asset, because in a capitalist system, real wealth is built through owning assets through your capital. And the more assets that you can own, the more money and the more wealth that you will accumulate. But it requires you to put your money to work, even if you're starting with $10 or $100 or $1,000, because this is the same thing that the biggest institutions, the biggest banks, the biggest players in the world are doing, which is how they're able to make so much more money. You can see how big it is here, but it starts here. That way you can start working your way, flipping your way from 1,000 to 10,000, from 10,000 to 100,000, from 100,000 to 1,000,000. But you got to get started with the first 1,000, or maybe even the first 100. That way now you can start working to increase your income. And this might be through the labor market, through your work, but also through the capital market, through investing your money and putting your money to work. And this brings me to number 8, not thinking long term, because YOLO. Why would you want to wait to have a nice car when you can have the nice car now? Why would I want to wait to have the nice clothes when I could just finance them now? And we start developing the short-term mindset thinking, where we're only thinking about today, we're thinking about maybe tomorrow and perhaps next week, but the wealthiest people are thinking further out. When you start talking to millionaires and you start talking to people who are worth hundreds of millions or billions of dollars, they're not talking about what they're going to do with their money next week or next year. They're talking about what they're going to do with their money in a decade or decades from now. Broke people talk about what they're going to do tomorrow. And this is where now you got to start changing the way that you think. And if you really want to become successful, now it's about reframing how you're spending your money, how you're investing your money, and what your investment horizon is. Because the biggest key to becoming successful is not just how much money you invest, but how long you are investing your money for. Because the longer you can put your money to work, the bigger the wealth you will accumulate is. Number 9, you're focusing on the price more than the value. Have you ever heard something like this before? $400 for a class? Are you crazy? Or $3,000 for coaching? Out of your mind? Or $30,000 for consulting? No way! All of these objections focus on one thing, price. But what you're ignoring is the value that you get. I mean, if you pay $300 or $400 for a class, but you can make $1,000 from the education that you get, is it worth it? I'll leave that up to you. If you pay $5,000 or $4,000 or $10,000 for coaching, but you can make 50 grand, is it worth it? Well, I'll leave that up to you. If you pay 30 grand for some sort of consulting, but you can learn how to make an extra 100 grand, is it worth it? Again, I'll leave that up to you. When I was first getting started as an entrepreneur, I used to hesitantly buy some of these $1,000 classes. But what ended up happening through each one of these $1,000 classes wasn't that I saw this breakthrough thing that I've never heard of before, but in each one, I found one thing in each one of the classes that made me many times more how much I paid. Sometimes $5,000, sometimes $50,000, sometimes hundreds of thousands of dollars from one thing, one lesson that I learned from paying $1,000 for an entire class. Then as you start to progress and you make more money, well, the cost of education also goes up. Now you go from paying $1,000 for a class to $3,000 to $10,000 for coaching. And at first I was like, oh my God, that's a lot of money for coaching. And then you do it. And it's the same thing. You learn a couple things now that can help you, hopefully, make at least 5 times more what you paid. And then you go on to consulting, people that are actually going to work with you in your business. And now this is going to cost many times more than that, where now I'm paying sometimes more than $100,000 for some sort of consulting. But why? Again, the goal is to make many times more than what you pay. But it requires work and it requires an investment on your end, because if you're not willing to work, then it doesn't matter how much money you pay, you're not going to get anything out of it. So you have to be willing to invest in yourself, but you also have to understand the difference between price and value, because sometimes, or many times, people get so hung up on price. This thing is expensive, but you're completely ignoring the value that you're going to get. And if you want quality, if you want things that are higher end, it's going to cost you more money. Now you just have to understand what things do you want to invest in for the quality. Like for me, I invest in quality education, quality consulting, quality coaching, but also on my own personal side, I like investing in things, or not really investing, but buying things that give me quality in terms of travel. I like traveling in comfort. I like having nice places to stay. I don't really care about having a really nice car right now, but I'll spend more money on a nicer Airbnb. And this is where you got to understand what type of things do you want to invest in more? What type of things do you want to pay more money for? What quality matters to you? And make sure that you're getting the value, but you're spending not based off of price, but value on the things that really matter to you. And number 10, your life revolves around money. There's a good quote that I really like. It says, some people are so poor that all they have is money. Money is important. Don't let anybody tell you otherwise, because if you don't have money, you're not going to be able to pay your bills. You're not going to be able to have the lifestyle that you want. You're not going to be able to give your spouse the life that they want. You're not going to be able to give your kids the education that they need. You're not going to be able to give your kids the vacation that they want, and on and on and on. If you don't have money, you're going to face a lot of money problems, but money can only solve money problems. More money is not going to make you happy. More money is not going to make you fit. More money is not going to make you find a spouse. More money is not going to find you all these things that you need in your life. And this is where you got to understand how you can live a more holistic life. Money can help you buy a better gym membership. It can buy you better food, but it can't change your mindset to actually go to the gym, and it can't stop you from eating at McDonald's every single day. So this is where you got to understand how money impacts the different part of your life, but understand that we're living lives here, where you have families, you have your physical health, you have your mental health, you have your spiritual health, and the financial health. And the things that I talk about here focus primarily on the financial health, because these are things that I wish that I would have learned, and these are things that I feel like I have learned and done a pretty good job at. But I also want you to remember that on your journey to wealth, there are many more things that matter in addition to money. So don't just completely ignore everything else, and remember how the different aspects of life play a part in your life. That way you can live a happy life and also a wealthy life. We have this culture where it is very normal and glorified to almost be bad with money. People like complaining about money problems on social media. They love flexing all the nice stuff that they can't afford on social media. And so what I want to do today is talk about some of the most important money habits that you have to have before you turn 40, because now until that time you want to be making sure you're working on these money habits to get it all in place. That way you can really set yourself up for financial success and wealth. And it all starts with number one, stop bleeding cash, and in this case, knowing how to pay down your debts. Because when you have consumer debts that are consuming you, which are your student loans, your credit card debts, your home equity lines of credit, your hard money loans, your payday loans, your buy now, pay laters, these types of debts are where you're spending your income today to pay off all the liabilities, all the luxuries, all the consumer expenses that you couldn't afford yesterday. When you get stuck in this type of rat race, all you're doing is you're going to work today to pay off your banker for the things that you bought yesterday. I was watching a podcast yesterday, and what they were saying was the number one way for you to become wealthy and set yourself up for financial success is to pay off your student loans before you turn 30. And that's a great thing to do, but what happens now if you have $500,000 worth of student loans because you went to medical school and you didn't graduate until you're 28 or 29? Or what happens now if you're 22 years old and you have $40,000 worth of student loans and you don't really start paying it off until you're 28 or 29 or 30? And so yes, if you can pay down your student loans ASAP, that's great, but by the time you're 40, you have to know how to pay it off, if not pay it off completely, because this is where it's not just your student loans, it's your student loans, the credit card debt, all those debts that are for your consumer liabilities, the things that are not putting money in your pocket. If your debt isn't paying for itself, because even student loans fall under this category, if your debt isn't paying it off through its own asset, you need to pay it off as soon as possible. Now, as much as people try to strategize the best way to pay down debt, at the end of the day, the debt strategy method ultimately comes down to this. This is your debt that you have, and if you want to pay it off, you need to have cash to throw at your debt to pay it off. And there are two ways to get this extra cash. Either you can spend less money or you can earn more money. In either of these cases, this is going to give you a bigger margin because now you have your income and your expenses. Either you can increase your income or you can cut your expenses, or you can do both at the same time. This is going to give you a margin, which means you're going to have cash that you can use to attack this debt and pay it off. And the faster you pay it off, the less debt that you're going to have to pay because, well, the less interest that you pay. Because now the more you pay today, the smaller your principal balance will get and the smaller the interest that you're going to have to pay now because your balance is getting smaller. So it literally pays off to attack your debt sooner rather than later. This is where people try to get into the nitty-gritty. Should you follow the Dave Ramsey model, which is the snowball model, where you're paying off the smallest debt balances first and then you're gradually getting bigger and bigger and bigger? Or do you follow the debt avalanche method, which is now you're paying off the highest interest rates first? It really doesn't matter. The key here is the more money you put in towards your debt, I don't really care which method you follow, the more money you put in towards your debt, the faster you're going to be able to pay this off. And once you stop having this debt, once you stop bleeding cash, now you can take this extra money, this margin that you have now, and put it to work to make you wealthy. Because when you get stuck in this system of constantly just having all of your money going out to pay your banker's the one that's getting rich, but you are now working to keep your banker rich. So you want to pay this off as fast as possible, that way you can use your money to make yourself rich. The second money habit that you have to master if you want to become wealthy is you have to know how do you spend the money that you have. Because we live in a society where you don't have to be able to afford something to be able to buy it, because you can buy pretty much whatever you want thanks to the help of credit cards and lines of credit and buy now, pay later. But that's going to put you right back into the problem that we just solved, is how do you pay down the debt? Because now when you're just buying things that you can't afford, well, now you are going to spend tomorrow's income paying off your yesterday's expenses. So what you want to do now is you want to understand the difference between being able to buy something and being able to afford something, and then spend your money based off of that. Dave Ramsey said it the best. He says that you need to act your wage. And the way that you can do that, the simplest thing that you can understand is my rule of 5 when it comes to your liabilities, which are not necessary to you living your life. And that means in the rule of 5, if you cannot buy 5 of them, you cannot afford 1 of them. It's a very simple rule of thumb that will help you understand what you can afford and what you can't afford. And this also means that you have to understand how do you spend money on things like your car, because pretty much everybody thinks it's normal to have a car payment. Because now when you want to buy a car, who's going to pay for a car in cash? Because now you can either lease it or you can have a car payment. Now leasing can work for some people or business owners in some situations for the tax purposes, the tax advantages. But I want you to think of leasing like flying first class. It is not the cost-effective way to fly. It is a luxury, and you're paying extra for that luxury. That's what you get when you lease a car. So leasing is buying that extra luxury. It's flying first class. You're buying the extra luxury of being able to now switch cars and do everything that you get with a lease. Now, when it comes to actually buying the car, if you want to buy a car and you can't afford to fly first class, you shouldn't be leasing. Now you're comparing, okay, do I buy it with a car payment or do I buy a car outright? Right now, at the time of me recording this video, the average car payment for a new car is $644 a month, and the average payment on a used car is $488 a month. Now, not only do you have this car payment, but then you have to pay for your insurance, you have to pay for your car registration, you're gonna have to pay for your maintenance, and if you got the nice car, you also gotta pay for your premium gas. And then what happens to so many people is you get into this car payment game, where now you buy this car, you own it for 4 to 6 years, and then you pay it off, and then as soon as you pay it off, you feel a little weird because now you have a car with no car payment. So what happens? That's when people go out, they sell this car, and then they go and buy a new car, and then they start this car payment game all over again. So you just finally paid off the car, but then you started all over again. So then people keep these car payments going forever because it's so normal to have these types of car payments. But let's do the opposite now. What if instead of having a car payment, your car payment was going to invest in you? That way you can become wealthy. So let's just assume now that you took $550 a month, and you, instead of buying a car, you use this money to buy you investments, whether it's on the stock market, maybe you're building up a real estate fund, because now with real estate crowdfunding, you can invest $500 a month, but you're investing $550 a month, and you get just a 7% average return on your money. And you do this from the time you turn 21, which is when many people start this car payment game. And you do this until you retire. And you don't increase the amount of money that you're investing every month, even though your car payments are probably going to go up every 5 or 6 years because you're going to keep buying more and more expensive cars. But I'm going to assume now that you're only going to pay $550 a month into your investment portfolio every month from 21 until retirement. Well, if you do that for 45 years, guess what? You're going to have a retirement portfolio of over $2 million. Versus if you just pay this $500-600 a month for your car every single month, after you get to retirement age, guess what? You're going to have a car worth next to nothing. Cars lose value each and every day. Sure, maybe your car, if you have a nice car, will be worth $20,000, $30,000, $40,000, maybe 50 grand. But that's not $2 million, because here you're buying assets. Here you're investing this money into yourself to buy an asset. Here you're taking this cash and you're paying interest on it to buy a depreciating liability, something that's dropping value each and every day, and then you're paying interest to the bank on top of that. Now you might be saying, but Jaspreet, I need a car to get to and from work. Yeah, you're right. But do you really need a $40,000 or $50,000 or $60,000 car? I like nice cars. I want you to have a nice car, but the thing that I want you to understand is that your car is a liability. It's not making you any money. I still today drive a car that's worth about $500. Actually, 2 days ago, I got a call from my homeowner association because my car, it doesn't have a bumper on it anymore. And they called me and they said, hey, we got a couple of complaints from your neighbors saying that there's a black car in your driveway that's an unusable car that's just sitting there because they thought that it was a junk car sitting in my driveway, and they said that I should put my car into a storage unit. And I said, excuse me, well, this car takes me to my office every single day. I've been in California for a little while, so I guess that's probably why they were getting these complaints. But I drive my car to work every day and it takes me everywhere. And yeah, while I don't have a bumper, everything else is working. Now look, I make a good income, and yeah, I probably will buy a very nice car someday. But for me, I understand that my car is a depreciating liability, and right now I'm investing very aggressively. I don't want to spend 100 grand or 200 grand on the car today because I know that I'm going to take this cash and I can reinvest it. I can put it back into my business, market briefs. I can take this money and go out and buy stocks and go out and buy real estate. I can find the other opportunities because I am so focused. I am laser focused on building this thing that I never had, this wealth that I never had before, because I know how important it is for me, and I'm willing to sacrifice that nice car today. I will buy a nice car. Okay, I'm not saying you gotta drive a junk car for your whole life. I'm gonna buy a nice car. But I understand how it plays a part in my life because I understand the difference between an asset and a liability. And I'm more focused on building this than I am focused this. This is my number one priority. Well, my car is just taking me from A to B, and when I'm ready, I will buy another car. The third thing that you have to understand is how do you invest your money? And when I say how do you invest your money, I don't mean putting your money into your 401k or your IRA. If you're doing that, fine, but that should be the very base. That should not be the tip and end of your investments. You need to be investing your money yourself. Now, if by this time you realize, okay, I suck at investing my money, I hate investing my money, then maybe you can consider getting some sort of financial advisor or money manager to help you with that. But if you don't, now you got to figure out how you're going to be investing your money yourself. And what you're going to realize is maybe you're going to like stock market investing. Maybe you're going to like real estate investing. Maybe you're going to like cryptocurrency. Maybe you're going to hate stocks but love real estate. Maybe you're going to do something like that, but you have to understand how do you invest your money. And this starts with the basic education of understanding how you get paid. Because the way you get paid is going to dictate how you invest your money. Because you can get paid from cash flow, which I'll label CF, or you can get paid through appreciation. And this is when your investment value goes up. The reason why I love investing in real estate is because I can get predictable cash flow from my real estate. So the way it works is once you buy a property, whether it's a home, an apartment complex, whatever it is, you buy this property, you own it, and now you're going to rent it out to somebody else, and somebody else is going to be living here. Let me draw this person right here, draw him a nice mustache, or as we like to call it in my native language, Punjabi, a much. This person is going to be living in this property, and then they're going to be paying you rent every single month for living in your home. Now the nice thing is, once you understand the ropes, once you understand how it works, it's going to be very passive on your end. Like, I don't know who my tenants are. I don't get involved with the day-to-day maintenance. I'm not involved with paying the bills. I have a property management company who the tenants deal with, and they do all of that work A to Z. But what they also do is make sure that I get paid. They deposit this money into my bank account. Now, of course, the property management company takes a fee, right? They're going to charge you money, so your rents are going to go down a little bit, but it gives me back my peace of mind. It gives me back my time, because now that I own the asset, this asset can generate me cash flow forever, as long as I own the asset and as long as the asset exists. And now I'm getting this cash flow, because now if you can think about it in terms of stacking assets, well, for me, I know that every house that I buy, it might put between $500 and $700 into my pocket of profit every single month. And so now it's just a game. How do I stack more? If I have 10, that's 5 to 7 grand of cash flow every single month, essentially passive, that I don't have to go and work for. If I can get 100, I know it's going to seem really far away. How in the world can you get 100? Because that's very hard, but that would be $50,000 to $70,000 worth of cash flow every single month. Now the question is, how do you put it in action? How can you buy 1 a year? And then as you start to grow, maybe 2 a year. And it's all about putting the plan in action, because the hardest one is the first one. But this is one way that you can get paid, is through cash flow. The second way is through appreciation. Appreciation is when the value of your asset goes up. Now you can do the same thing in real estate, where people will go out and buy a home for, say, $200,000 and then hope that this home will be one day worth $300,000 and then sell it for a profit. But I don't like to do that with real estate, because with real estate, I'm buying this cash flow. The people that get burned the most in real estate are the people that do this. They start looking for these speculative properties. They're hoping that they're going to be able to sell it for a quick profit. I don't like doing that. I'm not a trader. I'm not a flipper. I like to be a long-term investor, which is why when I invest in real estate, I don't care what's happening with housing prices. The only thing I'm looking at is how much cash flow that I'm getting. However, you can build this appreciation as a long-term investor. Because remember, there's a difference between trading and investing. Trading is now when you're trying to flip something. You buy something for 100 grand or 1 grand or $100 today, and then you hope that you can sell it for 50% more in the next 6 months. I don't play that game. So when it comes to appreciation, I'm looking for now investments that I believe in for the long-term value. This can be stocks on the stock market. It could be my real estate, where I'm not buying it for the appreciation, but if I get appreciation, that's icing on the top. Or it can also be cryptocurrency, if you believe in crypto. If you don't believe in crypto, don't buy crypto. But now, the whole idea here is you want to look for these investments that you can hold on to for the long term. And by long term, I don't mean 6 months. I don't even mean a year. I'm talking about multiple years, if not decades. So now, this is something that you believe in, that you want to hold on to for the long long term. And in the stock market, if you don't want to get into the business of finding, researching, and investing in individual companies, well, then you can also invest in ETFs. An ETF is an exchange-traded fund that gives you exposure to a lot of different stocks. So now you can invest in ETFs that give you exposure to the 500 biggest companies on the stock market, the S&P 500. You can invest in ETFs that give you exposure to tech stocks. You can invest in ETFs that give you exposure to energy stocks. You can invest in ETFs that give you exposure to healthcare stocks. So if you know what it is that you want to invest in, but you don't know the best company to invest in, then you can just invest in the ETF. And now, if you're still like, I don't know how to go about doing that, well, then what you can do is just set up a passive and automated system where now every week you have some money that's automatically leaving your bank account and automatically being invested into the ETFs that you want to invest in. I have one of these set up where every single week, for me it's on a Wednesday, it doesn't matter what day you pick, but every Wednesday money gets pulled out of my bank account and it gets automatically invested into my portfolio of ETFs. So that is my passive strategy, but then I also have an active strategy where now I'm looking for good investments, whether it's in the stock market or the real estate market or the crypto market or with startups. I'm looking for these good investments, and then when I see a good buying opportunity because prices go down, well, that's when I come in and buy. Typically, now it's becoming a little bit more awareness of this on YouTube thanks to education on these platforms, but typically what happens is when these asset prices go down, people get scared, they run away, and then they sell. But for me, that's a great opportunity to buy. Like I was buying when the 2020 crash happened. I was buying pretty aggressively. I was buying real estate after the 2008 crash happened. I was buying cryptocurrencies when we saw the last cryptocurrency crashes. So for me, crashes and down markets are opportunities for me to buy instead of opportunities for me to panic and sell, and that's where you want to find the right opportunities there. Now you can also generate cash flow from the stock market. Like if you invest in a dividend paying company, some companies have a big profit at the end of the year and they'll just give it away or most of it away or some of it away in the form of dividends, which is literally just like a cash payment to you and it gets automatically deposited in your account. Many companies pay a dividend every quarter, meaning every 3 months. And so if you invest in these dividend paying companies, your goal is again, seeing this appreciation, meaning seeing the long-term value of your stock investment go up. But in the meantime, you're getting paid while you wait because you're getting this sort of cash flow. So if your goal is just to build another stream of income, you want to have another stream of income coming in that's passive, well then what you can do is you take that passive investment strategy that I was telling you about and now look for either dividend paying stocks or dividend ETFs. That way now you're just working over the years to build up another stream of income, because if you do that and you stay consistent with it and you do it for years, you do it for a decade, what you're going to see is now all of a sudden you have just built a brand new stream of income, and the goal is for your stream of income to replace your job income. That way now you're working for your job income, but then you also have your passive income from your dividends or your real estate that's paying for your lifestyle. So now you just doubled your income without doubling your work, because now your dividend income is paying you without you working, and then your job income is paying you with your working. And then whenever you're ready, you can either cut down hours from your job or you can keep working the job. That way you can keep building up your investment assets. But the key here is you need to know what your goal is. Do you want this? Do you want this? And know where it is that you want to invest. The fourth habit that you have to understand is now how do you save money and where do you save money? So the basic end of this is you got to know how to live below your means. By the time you're 40, you have to know how to spend less money than you make, but you got to understand then when and how do you save money and when is it right for you to spend money? Because when you save your money, well, there should be a reason. And what I like to say is that you should be saving money for one of three reasons. You should be saving your money for an emergency, you should be saving your money for an investment, and you should be saving your money for big purchases, and that's it. If you're not saving your money for one of these three reasons, then you are not saving your money smartly. So every saving dollar that you put aside needs to have a strategy and a reason to be saved. Now when it comes to your emergency savings, you want to have somewhere between 3 months and a year's worth of expenses saved, depending on what your risk tolerance is. If you hate the idea of taking risk, if you don't like the idea of investing, then put aside a year's worth of expenses in your savings, because that will even cover you through the worst case scenario, and then invest everything after that. But if you have a higher risk tolerance, then maybe you only need 3 months worth of savings put aside. But then this also goes to now, how do you now save strategically when it comes to your spending? Because in the beginning, we talked about spending your money when it comes to most of your expenses. But now as you start to become a little bit more financially savvy, as you start to build wealth, you want to be spending your money the smart way and not just saving every penny because, well, you can. Because the ultimate goal of having money is to be able to use the money, because if you don't use your money, it doesn't give you any value. So now the question is, how can you put your money to work and use this in a way that's going to give you the most benefit? Like one thing that you can do, which is what wealthy people do, is they use their money to buy back their time. So if there are things that you hate doing, maybe you don't like going to get groceries. I hate going to the store. If you don't like going to groceries or getting groceries, you don't like cooking your own food, well then now you can use your money to pay somebody to do that. Now there's an added cost there. You got to pay somebody to get your groceries, so you're going to pay a premium for that. If you're going to hire someone to cook for you, there's a cost to that. But you're buying your time back. And now as you're on that journey to build wealth, you have to start valuing your time. If you can pay somebody $25 an hour to cook for you and your time is worth $50 an hour, well, you just bought your time back and made a profit. This also means you got to understand what's important to you. For me, name brand stuff and a nice car aren't on the top of my list. However, I do like comfort and I do like certain luxuries. Like if I fly international, if I'm going to India to visit family, that is a 20-hour journey on a plane. Well, on that plane ride, for the most bulk of my life, I was flying economy in the back seat, sitting like a sardine. I don't like doing that anymore. So now I'm willing to pay for that added comfort of sitting in business class or first class, which costs significantly more. I mean, it costs like 5 times more to sit in a business class or first class seat when you're going international, but it's worth it to me. So I will pay a lot more money for that because that value gives me value, something that I want. And when I travel, I like to be able to travel. So I spend money on traveling. I want to have a nice hotel room. I used to be the one that would fit 10 people into a $24 or $44 a night hotel or motel room. Now, I'm getting nicer rooms. I want that nicer comfort there because that provides more value for me. And you got to understand now, how do you save strategically? So we talked about the 3 places, right? The reasons why you save your money, but now don't just save all of your money to save it as you start to get deeper into your wealth journey. Figure out what's important to you. Spend money on the things that provide value to you. And the things that don't provide value, well, yeah, you can make those sacrifices because it's not that important to you. If you keep living that life where all you're worried about is what other people will think, well, you're going to be spending your money to make other people who don't really care about you and people you don't really care about, you're doing it just to impress them, but no one really cares. You're blowing your money on the things that don't matter, but this is where you got to know how to do it the right way. And this brings me to number 5, which is you need to know how to protect your wealth, because now as you start to build more wealth, what you're going to realize is when people realize that you have money, they're going to try to take their hand, put it in your pocket, and take some of your money for them. And you will see this in a number of different ways. Maybe people will try to sue you. Maybe it'll be in the form of taxes. Maybe it'll be something else. But this is where you have to know how to protect yourself legally and financially by building shields around yourself. And I'm telling you this from personal experience. Like, my first real estate deal ever was the most difficult and probably one of the biggest headaches. Now, it was a profitable deal. I still own that property today, but I learned a lot from it. And my first tenant also sued my real estate company because the claim was that my bathtub in that property was too slippery when the water was on. So the claim was that because they would turn the water on, the bathtub would get so slippery that it caused this person, one of the tenants there, to slip and fall. And because of that, they were suing my real estate company. Now, the interesting thing was, then the reason why I have a property management company is because they document everything. They refused to let my contractors in after that happened because they said that there was a chip in the paint on the bathtub, which was about the size of a quarter. So that chip of paint, they said, contributed to the bathtub being slippery. However, they did not let us make that repair. And second, they'd also admitted that the reason why they don't want anyone to make a repair there is because the person who slipped fell at a barbecue playing some games, and that's where he got hurt. And so because he fell at the barbecue, that we can't come in there. So we had all this documented, so it was a frivolous lawsuit. The judge threw it out. However, it was something that I had to go through and learn because in America, you can sue anyone for anything. It's just the way the system works. So how do you protect yourself? Well, for one, if you're investing in real estate or if you have a business, you want to have a legal shield. Maybe you create an LLC or an S Corp or maybe a C Corp, depending on what your company is. You got to talk to a tax professional or an attorney in your area. Most of the time, probably an LLC or a S Corp is going to do the job for you. And then once you have your business entity set up, you also want to make sure you have insurance. You got to have insurance for your property, your properties. You got to have insurance for your business. If you own a business and you have employees, you got to have separate insurance for that. So you want to make sure you have your different insurances set up. Have health insurance for yourself. Have health insurance for your family. Have your insurances for your property, your personal property, your car, your home. You know, all these things are not fun to have. Maybe you have life insurance as you're working to build your wealth. Life insurance is something that can provide you the sort of bridge insurance as you're building your wealth and owning assets, because your goal should not be to rely on your life insurance to take care of you or your family. Your goal should be for your assets to take care of you and your family. So that's one of the things that you can have set up. And then you want to make sure that you talk to an attorney, an estate planning attorney. An estate planning attorney is going to help you now understand how do you put all of your assets together. That way, whenever your time comes, because all of us have a limited time on this earth, how will your assets get passed on? Maybe you have a will, maybe you create a trust, maybe you do some other sort of fancy estate planning, depending on how much wealth you have, on how you can start planning to pass your assets down to somebody else. So these are things you need to plan for, because if you don't, then you're going to run into a situation where you can create a lot more risk, a lot more fights within the family, a lot of other issues, but you can avoid all of that by just planning for it. Now, I know no one likes to plan for worst case scenarios. Like, insurance is not something fun you want to pay for. No one likes to plan for what happens after you die, but the reality is if you don't, and something bad happens, well, you're taking on all the risk, and it can cause a lot of issues when you can prevent all of it by just protecting your wealth and taking these precautions when times are okay. I mean, it's just like investing your money. How do you take advantage of a market crash? Well, you learn and you put money aside when times are good. So it's preparing when times are good for a bad time. And it's the same thing here, where you want to prepare for when things go wrong during a good time. You graduate school when you're 20, 21 years old, and now you got all these student loans, and now you're finally in the real world, because for the last 20 years of your life, people keep talking about what the real world is going to be like. And now you enter the real world and you get a job, and now you need an apartment and you need a car to get to and from work. And so now you got these student loans, you got your car payment, and you got this apartment fee that you got to pay,